If you are interested in Disney and are curious whether it is a good time to buy the stock, stay tuned. Hi guys, this is Dan from the Investment ABC, and in this video I want to share my analysis on Disney stock with you guys. Disney is one of the few companies most likely all of us know. We were raised with movies like Aladdin or The Lion King when we were children. Disney was founded almost a decade ago in 1923 by the two brothers Walt and Roy Disney and has grown into one of the most famous and successful companies in the world since then. As an investor, I really like companies that have been operating for a long time because they have proved that they have a unique moat which gives them an advantage over their competitors. We can have a better understanding of Disney's moat if we have a look at their revenue segments and how they are interconnected. The first segment is Parks, Experiences and Products, which includes 12 theme parks and 53 resorts across 6 destinations around the globe and their own cruise line. This segment generated 37% of all revenues in 2019. The second segment is Media and Networks, which generated 35% of all revenues in 2019. This segment includes media like ESPN, the Disney Channel, ABC News, or National Geographic. The third segment is Studio Entertainment with 16% of all revenues. This segment includes popular film studios like Pixar, Marvel, 20th Century Studios, and Lucasfilms. And the final segment is the future hope for Disney's revenue growth, the direct-to-consumer and international segment, which includes Disney's streaming services, Disney+, ESPN+, and Hulu, overseas media businesses, and global advertising sales for the various media channels. This segment accounted for 13% of all the revenues in 2019, but will most likely grow way stronger than the other segments in the next few years due to the streaming services. Disney's moat comes from the synergies of its 4 segments and is very strong in my opinion. As an example, Disney is making great movies like Aladdin or The Beauty and the Beast and also acquired brands like Marvel or Star Wars, which are extremely popular with the kids. Because they love the movies, these kids insist to visit Disneyland no matter what, and their parents most likely will fulfill their wish than to take them to another theme park even if they have to pay a little more extra. Another synergy lies between the film studios and the streaming services, for example. Disney will upload its new movies exclusively on Disney+, which will lead to a differentiating future compared to other streaming services like Netflix or Amazon Prime. The good thing for Disney is that they have already produced the movies for the cinemas, so they don't have any other major cost to upload it to Disney Plus later. So as you know, I like companies with strong moats at a good price. Disney ticks the moat box, but let's see if Disney is currently trading at a good price too. If we have a look at the chart of Disney, we can see that Disney was hit very hard by the current issues we are facing right now. Its stock price declined from $153 in December 2019, right after the launch of Disney Plus in November, to currently $106. Disney recovered pretty strong with the overall market from its low at roughly $79 last month. What is also interesting to observe is the long-term trend line and how the price is meeting the trend line over time over and over again. We can see that Disney's price increased quite steep starting from 2012 to 2015. The price ran up too quick, so it was no surprise that it went sideways for the last 5 years and underperformed other stocks. I like to buy normally companies when they are under the or near its long-term trend line and avoid them when they are too far above the trend line. So was the latest crash enough to justify a buy right now? To answer this question, we have to have a look at the numbers first. We can see that Disney grew its revenue from 2014 to 2019 from $48.8 billion to $69.57 billion. This is a total revenue growth of 42.5% over 5 years, or a yearly growth of 8.5%. We can see that the cost of revenue of Disney was pretty constant, around 54 to 55% from 2014 to 2018, and rose sharply to 60% in 2019. Same goes for the operating margin, which was at around 24 to 25% from 2014 to 2018 and decreased to 17% in 2019. The rise in the cost of revenue and the decline in the operating margin was due to the acquisition of 21st Century Fox in March of 2019 for 71 billion US dollar and the development of Disney Plus. The cost of revenue measures how many dollars the company has to spend to generate $1 in revenue, and the operating margin measures the profitability of the company. That means how many cents of profit is the company making out of $1 in revenue. The lower the cost of revenue and the higher the operating margin, the more profitable the company is. Earnings per share increased nicely from $4.26 in 2014 to $8.36 in 2018. If we have a look at the shares outstanding at the bottom of the table, we can see that Disney was buying back its own shares consistently, which helped to increase the EPS. In 2019, the EPS fell to $6.64, and the company issued for the first time in years new shares for the acquisition of 21st Century Fox. Another important metric is the free cash flow of the company. Free cash flow is the cash left over for shareholders after a company pays for its operating expenses and capital expenditures, also known as CapEx. Disney's free cash flow increased nicely from 6.47 billion US dollar in 2014 to around 9.83 billion US dollar in 2018, only to decrease to 1.1 billion US dollar in 2019. The acquisition of 21st Century Fox, the consolidation of Hulu, and the development of Disney Plus had its toll on free cash flow. On the other hand, Disney had to weaken its balance sheet by increasing its debt. The current ratio is the ratio between current assets and current liabilities, and it shows the investor whether the assets of the next 12 months cover the liabilities of the next 12 months. Disney's current ratio of 0.9 in 2019 shows us that they most likely need to raise more money this year. I like a current ratio above 1.5 to be on the safe side. Disney's total debt increased from 12.6 billion US dollar in 2014 to currently 38.1 billion US dollar in 2019. On the other hand, the company was able to almost double total stockholders' equity from 45 billion US dollar in 2014 to around 88 billion US dollar in 2019. Total stockholder equity is total assets minus total liabilities of the company, but you have to be careful in Disney's case, in my opinion, because if we have a look at the balance sheet, we can see that Disney has a lot of goodwill and intangible assets compared to the amount of total assets. A goodwill is an intangible asset that arises as a result of the acquisition of one company by another for a premium value. It is the difference between the purchase price of a company and its book value. The danger of a high goodwill in the balance sheet is that if Disney, for example, overpaid for the brands it acquired, it needs to write them down at some point, which might lead to a substantial loss in the future. The success of Disney is connected to its ability to transition away from broadcasting and TV media, which is struggling with losing subscribers. More and more people, especially younger ones, are not watching TV at all anymore. I, for myself, have Netflix, Amazon Prime, and YouTube at the moment, and that is basically all I need. This trend will just accelerate in the future, and Disney was smart enough to make the transition right now. At the moment, Netflix is the undisputed leader when it comes to streaming services because of its first mover advantage. But like in any industry, there is always space for a second follower. Disney Plus has certainly the ability to catch up to Netflix down the road, but it will take 4 to 5 long years to achieve that, in my opinion. The good thing with Disney though is that it doesn't need to compete with Netflix directly at the moment because it can operate for a while in a niche market. I for myself subscribed last month also to Disney Plus to check out the content, and I have to admit that I as an adult was quite disappointed because I have already seen many of the movies there. But I still like to keep my subscription because of my two boys who like Disney movies like The Lion King, for example, and I also want them to watch those cartoons of my times like Robin Hood or Aladdin. It is cheaper for me to pay the $7 per month for Disney Plus than to take the kids to the cinema. In my opinion, there will be millions of parents around the world who think exactly like me. Meanwhile, Disney is after acquiring 21st Century Fox, a giant in producing movies. Brands like Star Wars, Pixar, and Marvel also belong to Disney now, which will help them to win a lot of new subscribers in the future. Even for adults, at some point Disney Plus will be very interesting to own because most of the Disney brands are blockbusters or have a very high quality which you won't find anywhere else anymore. Many people won't watch all the movies in the cinema and instead of subscribe to Disney Plus to watch them there. Meanwhile, Disney can slowly invest into new other content and build value for children and grown-ups at the same time. Longer term, Disney has projected that Disney Plus will have 60 to 90 million subscribers worldwide by 2024, with one-third of those in the US. The company has told Wall Street it expects to spend a little over $1 billion on original content for Disney Plus in its fiscal year 2020, ramping up to the $2.5 billion range by 2024. Disney is charging currently $6.99 for its streaming service, which is almost half the price of that of Netflix. Last week, Disney reported 50 million subscribers, up more than 22 million since the last time Disney disclosed numbers 2 months ago. From these 50 million subscribers, 8 million are from India, which pay less than the viewers in the US. In India, Disney Plus is priced at around $3.92 per month and not $7. Furthermore, there are approximately another 5 to 6 million users who got a free one-year subscription when they were customers of Verizon's unlimited package. Also in Europe, there are most likely many users who signed up for the free monthly trial subscription to just check out the service. We have to see how many of these customers will stay with Disney. Even if we assume Disney will lose 15 million subscribers when the free trial period is finished, that would still make 35 million paid subscribers. If we calculate roughly 28 million subscribers in the US and other Western countries times $7 monthly cost, plus 8 million subscribers from India times $3.90, that makes $227.2 million in revenue per month for Disney. In my opinion, Disney will hit its estimated 90 million subscribers way before 2024. But if we just assume they achieve those numbers in 2024, that will be 90 million times $7 equals 630 million US dollar per month or 7.56 billion US dollar per year in revenue, which will be added to the top line. That is enough revenue to spend 2.5 billion US dollar on content and cover 1 billion US dollar in other expenses and grow the value of Disney Plus over time and still be profitable in this segment. I would estimate approximately 4 billion US dollar in profits per year for Disney Plus at that time. Currently, the whole world is basically shut down and Disney will be hit very hard because no one will go to Disneyland for a while on a cruise or watch movies in the cinema because either they are scared or will just save more money for a while. In my opinion, it will be very unlikely that even after the economies are opened again, we won't see a major recession which will hit earnings of most of the companies around the globe. No one can really predict how hard Disney's earnings will be impacted, but we can have a look at the past recession in 2008 and see by how much Disney's revenue and net income declined. Disney's net income fell from 4.7 billion US dollar in 2007 to a low of 3.3 billion US dollar in 2009, which is a decline of almost 29.5%. If we assume now that the economy is opened in the next 2 months and we will enter a really bad recession which will hit Disney's net income by 30 to 40% in the next 2 years, we could see Disney's net income fall from 11 billion US dollar to roughly 6.6 billion US dollar in 2021. Disney also most likely has to either get a loan or issue new shares to weather the lockdown at some point, and most likely they will also cut dividend payments. But Bob Iger, the former CEO, said that Disney would basically get an unlimited amount of credit if needed to weather the lockdown impacts. So let's further assume that Disney has to issue more shares at some point in the next 2 years to pay off some of its debt and increase the outstanding shares from 1.66 billion in 2019 to 2 billion in 2021, we would get earnings per share of $3.30 in 2021. And if we take a PE ratio of 15, that would give us a fair price of around $49.50. This is the worst case scenario without the growth revenue of Disney Plus. If you believe Disney Plus will be successful like I do, it can add another 2 billion in profits by the end of 2021. That would increase Disney's net income from 6.6 billion to 8.6 billion US dollar. The fair value of the stock would change to $64.5. Bear in mind that this would be my worst case scenario in a great recession type environment if Disney Plus is successful. If we now have a look at Netflix, we can see that Netflix has a staggering PE of 106. The market thinks at the moment that Netflix will grow way faster than Disney and that Disney Plus is no real threat to Netflix yet. I disagree here with the market and think Disney will at some point in the next 5 to 7 years surpass Netflix most likely. Netflix currently has 167 million subscribers worldwide, which took them almost 13 years to achieve. Since streaming is more common now and something everyone knows, Disney will most likely reach this number way quicker. Together with Disney's popular brands, movies, and financial strength, there will be a real threat for Netflix in the future. Therefore, I would give Disney a PE of at least 25, which would increase its fair value during a recession to $107.50, which is Disney's current price. If I'm wrong and the recession is milder than most of us think, the fair value of Disney could be almost double as the current price in my opinion. Currently, Disney is trading at a PE of 17.8, which is too low for its growth potential in my opinion. So the verdict is, if you love Disney as a company and it was too expensive to buy for you the last few years, I think at today's prices it is a good buy. I for myself bought Disney during the crash, sold some of them back at current prices, but will add more if prices are under $100 again. If prices are testing the lows, which is likely, I will buy definitely more. Even though I am a believer in Disney's future success, there are three main risks I want to emphasize. Number one, Disney maybe won't be able to create new other content into Disney Plus, and Disney Plus disappoints in the future. Number two, the high debt levels. And number three, the change in management. Long-term CEO Bob Iger resigned, and we don't know how his successor Bob Chapek will run the business. The CEO can make out of a struggling company a powerhouse or run a powerhouse into the ground, like the case of Boeing, for example. You have to decide for yourself if Disney will succeed long-term or not. This is just my own analysis and my assumptions could be completely wrong. Please do your own due diligence and comment what you think about Disney's fair value. If you liked this video, please support this channel by hitting the like button, subscribe for more videos like this and share. Bye guys and see you in the next one.